Good evening. How's everybody doing tonight? How's my audio? Could I get a thumbs up or a comment if I'm coming in good, or too loud, too quiet? Thank you, Steve. Perfect. Where's everybody joining us tonight from? I'm here in Fargo, North Dakota, where we're getting anxious to start doing some field work, and it's been raining and snowing this afternoon. So I just drove by a wheat field on yesterday or on Saturday that had been planted, and we're looking like we're weeks away yet. So we need a little bit of sun. We're not turning away the moisture, but need a little warmth and sun. So good to see people from all over the country: Nebraska, Colorado, Washington, Ohio. We got people from Illinois, North Dakota. Good to see you, North Dakota, Minnesota, California. Wow, everybody from all over the country. So good to have you here tonight. I was doing some analysis last week, showing a younger producer I know just the power of overhead when you start making these farm rent decisions, and just how big of an impact overhead has as you're adding and subtracting land. And that really got me thinking on just not only the financial aspect of it, but looking into some behaviors that I've seen on the farm, some bigger picture commodity cycle thoughts. And so we're just going to jump in. I spent some time over the weekend just basically doing a brain dump on different things related to farm rents. And a lot of it is, some of it's going to be common sense, some of it isn't going to be. Really, we're just going to, I wouldn't focus too much on the really specific numbers we're going to talk about, but I would just focus on the thought process and really try to take a couple things away, because in today's environment, obviously, when you're starting from a low margin, small improvements can make a heck of a difference for your bottom line. So we'll dive in right here and get started. So making tough decisions on the farm, it's really hard to make confident farm business decisions when we have all of this volatility. It's just not limited to commodity prices, but it's the combination of weather, inputs, just all of this volatility all thrown into one is a challenge, but yet at the same time, an opportunity. With this volatility, farm rents is something that is especially hard. It's just not a typical business decision. This is what really makes farms a lot different than most other businesses. Farms, I like to say farms a business. You need to approach your farms like a business. But when it comes to rents, rents are very unique compared to almost all other industries. There's just so many interpersonal relationships and just competitive dynamics. And how many CEOs live next door to all of their competitors? That doesn't happen. Farm rents are a very unique challenge and opportunity that I think people tend to gloss over all the intricacies involved with them. So what are we going to talk about today? Well, the first thing we're going to jump into is there is really no perfect answer here. This isn't a typical business decision. It's not cut and dry. It's not black and white. Overhead, overhead, overhead. That's really the prime driver in farm profitability. And most of you, if you saw my email, and we're going to focus on it here, where we're talking about different financial situations, overhead it's of the utmost importance when looking at different rent scenarios. Cyclicality, that is something else that we need to consider. Ag commodities tend to follow commodity cycles. There's some debate on what the distance is between peak to trough, and there's frankly a ton of uncertainty about the distance from peak to trough. But we always got to keep the cyclical nature of farm commodities at the top of mind. Then there's just a number of biases, behavioral aspects that come into play when looking at rent decisions. And we'll talk about some of those here at the end. And then finally, I just did a real brain dump at the end of a framework, a checkoff box that I think people need to look at when facing these rent decisions. Are we thinking about them emotionally? Are we thinking about them objectively? So if you wait till the end, we'll talk about a step-by-step framework, which I think makes a lot of sense in how to approach these decisions. So first of all, farming is hard. It's hard to make confident, proactive decisions because so many factors go into analyzing a farm's bottom line. You have weather, you have the commodity markets, you have inputs, and then you have the dozens, if not hundreds of factors that go into an individual yield on an individual farm. Farming is just really, really hard. And I was listening to a book recently that brought up an example of what seems like it might not be that hard of a problem to solve, but it's very, very difficult, and it's applicable to all of the factors that go into your farm's bottom line. That problem it's called the traveling salesman problem, salesperson problem. If you have, let's say, 20 different postal routes or delivery routes, and you know the exact locations of each of them, how can we determine what the best route to travel between all of these locations is? This is, I think about that. I heard this and I thought, well, how hard can that be? Because I think ingrained in my mind is to go to Google Maps and start typing them in and let Google Maps do that. But when you have a lot of different independent factors contributing to this problem, here the problem is, or the opportunity is, finding the route. It is extraordinarily difficult. This is an apples to oranges comparison to farming, but it does apply to the logic in so many different problems, or so many different factors are at play when determining a farm's bottom line. So pick any one of those points. That might be the trade situation with Mexico is one point. The trade situation with China is another point. We have your local weather as a point. The production in Ukraine, production in Brazil, a ton of different things at play here that lead to the financial outcome for a farm. And what does that really have to do with farming? Well, let's think about 50 different cities on that traveling salesperson route. How many to really analyze the opportune route for each one of those cities? Computer science, mathematicians say you really have to tick off each one of those different scenarios to find the ideal optimal outcome. Well, if you have 50 cities, how many combinations of 50 cities would we have to go through to find the optimal route? This is the number of possible combinations when we have 50 cities. So if you think that I think there's more than 50 different factors at play in a farm's profitability, and there are some correlations there. So this isn't apples to oranges, like I said, but the reason why I'm presenting this random factoid to you today is there is no perfect answer. We can make hypothetical guesses on future weather, future markets, but at the end of the day, to truly scientifically come up with an answer that would give you an edge, that would tell you, rent that farm, don't rent that farm, let that farm go, don't let that farm go, that is just impossible. So what we want to do here is we want to manage our risk. We want to approach things from a numbers-based standpoint, and we want to be aware of certain biases that impact our decision-making. We're never going to be able to find the ideal or optimal outcome to these decisions because there are so many factors at play. Once again, slightly apples to oranges here, but nonetheless, a lot of factors that contribute to the right answer. once again, there is no perfect formula. There is no perfect framework. We got to approach things logically. And the first step here is looking at just all the interpersonal weaving that goes into these decisions. I was on a webinar last year where they said, if you can cut out your top 5% of your farms as far as a cost per land cost per bushel of production, you just need to cut that top 5% out. Well, that's a lot easier said than done. What if you have a real dog of a farm that is tied to 2 good fields? What if you're renting some land from, a potential business partner, somebody who you might be able to purchase that land? This just is not a traditional business decision. It's not cut and dry. So don't let anybody, talk down to you, tell you what you have to do. There is no right answer here. You just have to make the best decision you can. So this isn't a traditional business decision. This isn't a build a factory versus not build a factory. Just so many it's the weaving here of so many interpersonal relationships, future opportunities, and just building the equity in your farm in a respectful fashion, in my opinion. So ignore people that don't understand that there is more to this than just the numbers. I tend to be a spreadsheet numbers-based farm, so I'm not going to understand all the interpersonal relationships that go into your land rent decisions, and I really never will. So if at the end of the day, you need to take all of those factors, the subjective and the objective, and really make the best decision you can. So getting on to something a little more concrete, kind of getting back into my comfort zone, let's take a look at the potential situation that I included in, on social media, in an email that really sparked this conversation, and that is the overhead impacts of letting land go or picking up new land. So here is the specific picture that I posted of some analysis that I did last week on letting a piece of farmland go. And some people were surprised by this. I knew what this result was going to be. I knew the direction of it, but the magnitude of the profit difference was a surprise to me. So what is going on here is the farthest left sheet of paper is our list of fields and our profitability per field. So we're going to take our least profitable field and we're going to cut that one out. So obviously, again, this is with the benefit of hindsight. This isn't how the real world operates, but I wanted to show the power of reduced acreage. So we let that field go, and it takes our profitability. The center column is without the field, $69,000 of profit. And the right column, the right piece of paper, is $136,000 of profit. So we're removing that money-losing field, and it has a significant impact on our bottom line. To do the math for you there, this is a 510-acre field. You representing, so that's about 15 to 16% of the acreage of this total farm. But I knew that we would see this result because I'm not retroactively going back and adjusting our overhead. So if we take a look at our overhead, without focusing too much on specific numbers, I think this overhead is actually a little bit high from what I see, but fairly realistic. So we're not changing anything. So we keep all of the overhead the same. Everything else, whether it's land, seed, fertilizer, chemical, fuel, trucking, crop insurance, all that stuff is adjusting lower. So these are the categories that are staying the same on this farm. Obviously, if we let land go, our repairs are going to be lower. Our depreciation is going to be lower. We'll probably have lower equipment payments, but we need to lower, in hindsight, we need to lower our overhead by about $70,000 to make our bottom line numbers comparable. You know, so let's just take a common sense view of this. So maybe our repairs could go down by $10,000. Maybe we could have $10,000 lower depreciation. You know, the biggest one would be here is, which I think is a specific action item for many, going back to 1, 2, 3 years, there were some screaming hot deals for leases. You know, big row crop tractors being leased for, you know, $15,000, $20,000 a year, whereas now that lease might be $25,000, $30,000 a year. So if you're being presented with the option to let land go, we need to just look back at what expenses can we take out of the equation to accommodate for that. You know, maybe we can trim, you know, who knows, $5,000, $10,000, $20,000 out of one of these other miscellaneous cost items, but really that doesn't get us to our $70,000. So, you know, for this farm, you know, we're probably kind of right in the sweet spot here, where if we go from 3,400 to 3,000 acres, we're probably going to need most of the pieces of equipment at what we had before. You know, if we even increase acreage, we're probably going to be able to cover more acres with the same line of equipment. So that's the first step here, is where are you at for your line of machinery? If you have to add overhead to pick up another quarter, another 50, another couple hundred acres, that really will create a headwind on your bottom line. But if you already have the equipment, you know, adding land can make a lot of sense, even at numbers that, you know, historically, you know, have been fairly, you know, uncomfortably high. So really, I would just laser focus on the equipment number and be objective and really be honest with yourself. Can you cover more acreage effectively with your current equipment setup? And so overhead is huge. I didn't want to just dive deep into every single one of those line items because it's going to be so different. It's really going to be so different from farm to farm. I did want to show you how I did this. You know, you don't have to use a software tool like Harvest Profit, but I'm going to jump in and show you really what I did in making this analysis. And I'm sorry, this is going to be fairly small. So I'll see if I can increase it here. Won't spend too much time on this specifically. But here is the 2017 profitability that we saw with that field included. And so in our tool, we can go to our fields and land costs, and we can just really simply archive a field. So we go into the field. I'll try to go slow here because I know sometimes I go a little quick in these videos. But if we archive the field, we now take that field and all of its variable costs and just throw it right out of our P&L. So I'm going to jump back into the P&L, and we can now see that our profitability has gone from 118,000 to 62,000. So with a tool like this, you can do it in spreadsheets. Heck, you could do it on a piece of paper if you wanted to. We can really go in and analyze different scenarios quite easily, adding land, adding the impacts of different land payments, the impacts of different overhead items. And really, you want to have a system in place. You know, once again, doesn't have to be what we have here, but if you want to have a system in place to do this high level analysis, sorry, I'm not sharing it. You should just have a system in place that allows you to track your profitability on a field by field basis so you can make these educated farm rent decisions. So once again, overhead is hugely important, but what I don't want you to forget about is the risk. What did I not talk about in that analysis? We simply talked about what is the impact on our P&L, but maybe more importantly, or as importantly, is your farm's balance sheet. So what I'm ignoring there, let's just flip that. Let's just say we're at the 2,900 acres and we're going to go to the 3,400. That would look amazing. We'd be adding, $70,000 of profitability by adding one field to our farm. But what that does not take into account is our working capital. Your working capital is, at the end of the day, a true form of business insurance for your farm. We cannot ignore the impact on our working capital. In this situation, we may choose that, hey, I'm okay with giving up a little bit of a profitability hit because that screaming hot deal I had on that tractor lease is no longer there. So I'll let that lease go and I will take my working capital from, let's say 25% of revenue to 40%. People often ask me, what can I actually do to increase my working capital? And this is a very specific example of that. So once again, overhead is hugely important, but we can't ignore the impacts of working capital. What a lot of this analysis would do, if you really dove deep, is it would tell you to push the limit all the time, have as much land as possible. But let's say you are in a situation where you farm 1,500 acres, you don't have much debt. You add one piece of equipment and you can go to 4,000. Well, you were just walking through a battlefield with no landmines. You're in a very risk-free situation to now all of a sudden you have laid a bunch of landmines in your path. The potential, the pot of gold at the end of the rainbow is bigger, but you risk blowing up your farm getting there. So once again, this is just like we have a bunch of different levers here that we can pull, and we need to keep them all in mind. Working capital. What is my risk? What is my downside? Let's do some scenario analysis for a good case, an average case, a poor case across the current position of your farm and the position that you're evaluating. So a lot of this stuff, it'll make perfect sense at time zero, but we obviously know that what's going to happen in the future is likely to be quite a bit different than what we think it's going to happen today. So yeah, here we go. Working capital. It's a big one that I wasn't factoring in there. I wasn't factoring in the potential uncertainty. We've been seeing huge amount of yield variability and price variability, and by having a working capital cushion, it allows you to take a little, it allows you to just more comfortably navigate, pay off debt, build equity. And so it's just a constant back and forth between, do we push the limits and try to maximize our profitability, or do we step back and build our working capital and reduce our debt? So the other thing, we're going to jump away from that, and we'll be kind of quick here. We always want, in addition to how do these land rent decisions affect your farm, from just an opportunity standpoint, a relationship standpoint with your current landlords, how does it affect it from a numbers standpoint, from both a profitability and a balance sheet standpoint? And the third thing here is cyclicality. Where are we at in the current commodity cycle when we're making these decisions? Farming is a little bit different, but here's a really great chart that comes out of a bank that focuses in commodity price research. They analyze stocks. And if you go to the left, we start with demand building, prices are accelerating, to all of a sudden prices fall, we have excess supply, we have high stocks, and then we end up, in the gray zone there. The stocks are drawing, prices, volatility has narrowed, prices have become a little more stable, and then all of a sudden we hit a supply constraint. In mining, which much of this chart is based on, supply and demand is highly tied to the capital expenditures that miners are putting out. In farming, it's acreage, it's weather, it's demand, a lot more unpredictable than other cyclical businesses, but just where are we at in the commodity price cycle? You can look at just, the general coffee shop talk, how much equipment is moving. It's easy in hindsight to pinpoint where the cyclical high was and where the cyclical low is. And really how I can best give you some guidance for how to make this decision is just, where are land prices gone? Where are rents going? Are you feeling bullish? Or are you feeling bearish and uncertain? When you're feeling bullish and complacent, that's a time to maybe rein it in. When you're feeling, when your farm's been beaten up, when your farm's been going through some tough times, a couple years of poor prices, then we maybe need to think counterintuitively and be opportunistic and take on opportunities. So we always want to be cognizant and recognize, where could we be at in the bigger picture commodity cycle? The old saying here says, when you are crying, you should be buying. When you are yelling, you should be selling. It's a lot harder. It's much easier said than done, but just realize over time, we have these, what tend to be shorter price spikes, times of greater margins, and then some more prolonged areas of less price volatility, lower margins, and just where are we at in that cycle? Inevitably, we're going to get back to a period where, corn and wheat just aren't going to rally 50 cents and soybeans just aren't going to rally $1. And we're going to see multiple dollar big moves, and we're going to make money, and it's going to feel good. We're going to look for opportunities to expand, but that's the time to hold back on the reins a little bit. We have some questions coming in. Feel free to ask a question. I'll try to get to them at the end. I don't want to take up too much of your evening here, but at the end of the day here, we just need to respect the cyclicality that is very present in ag commodities. Once again, much easier in hindsight. So the real art, there's a science of this, which is the numbers, which is looking at cycles, and there's an art of this, which is managing the relationships, the first factor talked about, but then the biases, the behavioral aspects that come in when we're making these decisions. So one, I can do a better job of farming it. We've heard that. Probably isn't a question here. It's more of a statement. Geez, the neighbor, he really does a terrible job of farming that piece of ground. And sometimes, that can be true. I've seen many times where it's true, but I've also seen almost just as many instances of, man, that low spot, just really, that ground just doesn't take the rain. I can see where the previous tenant had a heck of a time, farming that ground. Can you really do a better job farming it? So try to be objective, unemotional about the situation that is leading to the opportunity of when you're picking up ground. So this comment is definitely more geared towards when you're evaluating opportunities to pick up ground. A lot of these comments are. We tend to suffer from a little bit of an overconfidence bias. We tend to be a little too confident in our abilities to do things. We tend to think we can maybe do a little better job, myself included. I suffer from this as well. We tend to be a little overconfident in how we can handle things. So just keep an eye on that and truly try to understand if you can do a better job of farming it and look at it objectively. So the second one I always see If you're not growing, you're dying. It tends to be, for whatever reason, this mindset that has gotten put out in farmers' minds that consolidation is going to eat all farms. Farms are going to continue to grow. You want to grow your abilities, you want to grow your equity, but really this does not come down to an acreage thing. You obviously need to be growing in your skills, your abilities, hopefully your bottom line and your equity, but really that over the long term just isn't tied to acreage. I would say the average farm that I worked with consulting that has built equity, working capital over the last 5 years, nearly all of them are farming less acres today than they were going forward, or than they were 5 years ago. So what they're trying to do here is they're trying to essentially cut the fat, gain the muscle, and it's a lot harder to gain the muscle than it is to cut the fat. So they've let some equipment go. They've let some land go along with it. So just realize that this mentality of always be growing, I really don't think that exists. So try to grow your skills, try to grow your abilities, try to grow your knowledge, but just do not tie that to acreage. A lot of big companies want to scare you into thinking that, but I've seen in practice that is not true at all. The other one is, if it doesn't work out, I'll just let it go. Spring price on crop insurance is $5 on corn, $5 on wheat. We have great risk management in place. We have great crop insurance. I'm gonna pay up for this farm ground today. If it doesn't work, I'll just let it go. It's really hard to let it go. I've seen quite a few instances of guys that were gonna, if this I'll farm this ground for 2 more years, but if it doesn't work, I'll let it go. Well, when that 2 years comes up, our human nature tends to kick in. We can be over optimistic, or we can be overconfident. And so when you're looking at an opportunity to pick up ground, be honest with yourself on, if you add that ground, you're probably going to creep your overhead higher, and it's going to make it even that much harder to let it go. So just be honest with yourself about being objective and honest with yourself. Letting land go is much harder than you would think the day you pick it up. One of the reasons a bias that I've talked about numerous times is there's a bias, the choice supportive bias. After the fact, our human psychology tends to affirm the choices we have made. So once you make the choice, sometimes it's completely subconscious. It's something we can't control, but we try to find things that confirm that was the right choice, that support that choice we were made. So I'm not being critical when it's hard to let the ground go. Oftentimes it's wired in our psychology as humans to find reasons why it was right, and to find reasons to continue to keep farming it, to once again support that choice that you made to pick it up in the first place. One of the biggest ones, grass is greener on the other side of the fence. This tends to be a personal weakness of mine. I just moved from a small office into a big open office. I thought, man, it's going to be great to move into an open office where we can all collaborate. Well, now it's loud and annoying, so I want to go back to my own office, and I'm probably going to flip-flop back into wanting the bigger open office. And I see it all the time. This impacts everybody in every walk of life, not business, not personal. We tend to see, the positive things. The guy with the big grain setup, the guy with the big shop. Oh, what's he doing? He has more acres. Once again, this isn't necessarily a conscious choice. It can be a subconscious choice. So just remember that the grass is not greener on the other side of the fence. So there are numerous biases that come into play here. There's numerous behaviors. one of the biggest is that choice number 3. If it doesn't work, I'll just let it go. Another behavior that isn't mentioned here is when you add land, it's going to look great doing the financial analysis that we just walked through. Like I said, if you take that 2,900 acre farm, flip it to 3,400 acres, don't add any more overhead, it's going to look great. But that overhead is creepy. So if you choose to add a field, be really conscious about trying not to let overhead creep take your profit advantage away. And vice versa, if you're going to let land go, just look at it objectively. Can you cut your overhead enough to match the loss gross margin that accompanies that land? So here, we're going to walk through a framework for making these farm rent decisions. And I've just put together a checklist based on some best practices I've seen across many farms on how we can approach these farm rent decisions with the baseline understanding that there is no perfect decision. You have to constantly be measuring the risk versus the reward, and there is no perfect answer. But by following these steps, it can help you get to an objective, numbers-based decision that can hopefully work for your bottom line, reduce your risk while maintaining your profitability. So build a per field crop budget, a model, so you can make these objective decisions on what if I decide to, push on the throttle and try to add some farms? What if some opportunities come up? What if my farm is getting spread out across too many acres, too wide of a geography? I'm not doing the best job farming. Take away those 30-40% of your acres and chop your overhead and get draconian and really hammer your overhead and see objectively how adding or subtracting falls to the bottom line. This comes along with how much overhead do I need to add or can I shed when looking at adding land or subtracting land. So don't just think about it. Don't just go with your gut. Really pull out all your payments, pull out your equipment lineup. What can be sold? What would need to be added to maintain the best crop producing ability on your farm? So get detailed. Get out the fine-tooth comb when it comes to overhead. That's really the biggest factor at play here. Analyze your working capital impact. That flows into the fourth one. What are the tax impacts of this decision? Specifically, if you decide to downsize the size of your farm, if that comes along with selling land, or selling equipment, what is your tax basis in that equipment? What is really your true after-tax gain when letting that equipment go? So just understand the tax impacts. Have a quick chat with your CPA. And then where are we at in a typical commodity supply and demand cycle? Note here that I said typical. None of these follow, especially in farming where a lot of it's dependent on weather, none of them follow a typical, 4 to 6 years. We can be highly confident that that's when we'll see an upturn. But make an educated guess, a hypothesis of where we're at in the typical commodity supply and demand cycle. An easy way to do that is to just try to take an honest view of where your mind is at. Where, sorry, a little misspelling there. Are you bullish? Are you content? Are you optimistic? That's probably a time to be cautious. Are you bearish? Doom and gloom. It feels like there's zero probability of better times to come. Then we probably need to lean on being opportunistic. Next time we have a period of really strong prices, really strong margins, rents are going up, equipment prices are going up, that's the time to really focus on downsizing. During periods like we've had the last couple years, it isn't easy. It doesn't happen often, but there has been numerous scenarios of people picking up land at better opportunities than what we've had in the past. especially if you take into account the fact that yields have moved up and to the right. The other thing is, going back to, can you do a better job farming that? Do whatever you can to review objective yield data, satellite data, weather data on, comparing new fields to your current fields, trying to, we all know that fields look much different from the air than they do from the side of the road. So if you think you can do a better job farming, try to be objective and review that and try to gain an educated hypothesis, an educated opinion on what you could do, and put an action plan in place that here are 5 things I can do if I pick up this ground to increase its productivity, and what are the expenses. Complete a 5-year equipment projection. So going back to number 2, the overhead is huge in this. Think about where you need to be next year, in year 3, in year 5, where you're at today, and what the impact would be on both your cash flow and your working capital, to ensure that you aren't just digging yourself a hole by adding new land and burning your equipment out. So complete a 5-year equipment projection. It can be, it doesn't have to be 5 years, it can be 3 years, it can be 7 years, but just try to understand where your potential equipment expenses may be at in a few years. You'll complete a logistics analysis, like, are you truly going to be able to farm your ground as good as, as great as you can if you add a field, that's 15, 20 miles away, or vice versa. Maybe you have an opportunity to pick up a quarter of ground that's close to your farm, but you can let 300 acres, you're in a battle with a landlord over renting 300 acres. So you need to just look at, all right, if I let that land go, pick up the land closer to home, what am I spending on mileage? What am I spending on depreciation? So logistically looking at your farm oftentimes, doesn't happen other than, hey, this field is close. That's why I bought it at auction. That's why I rented it for top of the market price, instead of just using that gut feel. And it's always nice to farm ground closer to home, but try to put some numbers behind it. The other one, is the move accretive or dilutive for your grain marketing? And what that means is, if you pick up ground or if you let ground go, how does that affect the grain marketing window of time that you have? If you're already maxed out on your grain storage and you add a couple hundred acres, obviously that grain is going to have to find a home, and it's more than likely going to have to find a home at harvest. So you might be facing a 20-cent headwind on new land that you can't, with commodities that you can't store versus commodities that you can store. And maybe it's even as much as 50 cents a bushel. Vice versa, if you can store 70% of your crop, what if you have the opportunity to let an unproductive field go, let some equipment go, you can then store all of your crop, and all of a sudden you've increased your average yield, you've trimmed your overhead, and you've increased your price per bushel. If you can do each one of those just a little bit better, by factoring in your grain marketing, you can identify accretive, positive, dilutive, negative impacts on your average typical cash price per bushel. And then just put together some simple scenarios on, if you have an increased acreage base, what is your per acre risk? What is your risk with your crop insurance, with your APHs? Analyze how the new ground impacts the insurability of your farm as it stands today. How much risk are you adding? We get back to a higher crop insurance price, and if you've added 20% to your APH the last 5 or 6 years, you might be surprised at what a field or two, at an average or a market cash rent would look like. So just analyze where you're at, whether it's multi-peril crop insurance, some of this new gross margin insurance. Where are you at on a risk standpoint in the poor years? And then also, we need to think about the good years too. If we can limit our risk on the downside, participate in the upside, obviously there is more upside if you have more bushels to sell. And then finally, does this help you achieve your long-term goals? We need, in my business, in your business, you need to have some goals in place. If you don't have a goal in place, it's kind of like one of the better analogies I've heard. It's like if a soccer team was playing a game without a goal on the field, you just run around, you're always chasing opportunities, and really you can never score. So what is your goal? Maybe your goal is to own 500 acres free and clear. Maybe your goal is to just get back to some positive working capital, or maybe your goal is to not ever have to borrow money from the bank. Define your goal and see, how does this decision today impact that goal? If you don't have a goal, there's always going to be somebody bigger. There's always going to be somebody farming more acres. I talked to somebody who has a really impressive 4,000 acre farm, and he farms next door to a 10,000 acre farm, and there's a 50,000 acre farm, and then there are massive farms. So there's always going to be more, but if you have a goal, it can really prevent that endless chasing of opportunities that can get us in trouble and cause us to step on these landmines that were really unnecessary. And so a lot of what we've talked about here is, viewing your profitability, and a lot of the decisions that, a lot of the analysis that you would make here is going to tell you, one, don't let land go, two, add land. But at the end of the day, it's almost too nuanced for me to really take a deep dive into it in this webinar, but you really just want to focus on the risk as well. So don't minimize the risk associated with these decisions. And at the end of the day, if you manage that risk through some grain marketing, through some different insurance, through balance sheet, through pushing out your maturities, locking in your interest rates, take a look at every line item on your income statement and think about what you can do to manage the risk in that dinging your profitability. And then also just be objective. A ton of this stuff historically has got made based on gut feel, emotions, but really just try to focus hard on being objective. And then when it comes to managing risk, I'm going to end with a quote here. This is from Andy Redleaf, who manages an investment fund in Minneapolis. If anybody follows me on Twitter, this is the guy that had to pay his wife a $140 million divorce settlement. So he's been extremely successful in his career. And what he tends to focus on is minimizing risks, and the upside will take care of itself. And specifically, he says, people are compensated for mitigating risks rather than taking on risk as is often perceived. One of the biggest things we can do to minimize your financial risk as a farm is to decrease your per bushel cost of production. In a commodity business, that is one of the number one things. So as you're thinking about all of this analysis, we can kind of run around chasing our tail. There is no perfect answer, so these decisions aren't easy. Be objective, realistic, and try to come up with a scenario and some estimates of how does this decision impact my per bushel cost of production. If you can focus on being in the lower third, the lowest 25% of all farmers in the country, that to me is the best thing you can do for managing your overall long-term risk. So I jumped around a lot there, a lot of soft topics. We could really deep dive into some scenarios on specific numbers, but at the end of the day, every single farm is different. So I hope you can look at, I hope this checklist here gave you some interesting things to think about as you're evaluating your farmland decisions on whether to maintain the status quo, or add acreage or veer off and let farms go, and don't underestimate the impact of overhead on your bottom line. That is a huge importance of this. And so knowing your per field gross margins and your total overhead can really make you a powerful number crunching farm manager. So I'm going to take a look at a couple questions here that we received. The slides weren't changing for me. Couldn't see the chart. Somebody says, I still don't see the full effects of dropping the 510 acre field. I'll put together, it looks like there were some issues here with looking at our website and how our software operates. And so I will take a look at, I'll put together a presentation, no problem, and I'll send it to everybody on the list just so you can have it to look back on. Feel free to do with it whatever you want. So sorry for that. And yeah, I will send around a presentation. I hope this was, of some value here. I tried to talk a lot about how these decisions aren't easy and there is no right answer, but be as objective as possible. Approach, do different scenario analysis and really just focus on, gross margin on a per field basis, your total overhead, and how those two work in conjunction with each other. So I hope everybody has a wonderful evening, was able to get some value out of this. Hope Mother Nature cooperates with you and you have a safe, productive growing season. I really appreciate everybody who's following along with what we're doing here at Harvest Profit. I'm going to post, if you hang on one second, we made these hats here. I'll get really close to the camera. These little Harvest Profits hats with a grain set up here, and I think they're kind of cool. And I've got some, sent them to customers. I'm going to post a little questionnaire here. So if you would like a hat, you can fill out this little questionnaire, and I will fire you off a hat at no charge to you. We pay the shipping. So yeah, if you hang on one second, I'll post it in the comments. Really thank you guys for joining us here today. And if you have any questions, feel free to shoot me an email and I will do whatever I can to help you out. Thank you. Have a wonderful night. Have a safe and productive growing season.